Hi, my name is Alex Buriak, and I'm the Senior Vice President here at Jet Lending. This video is going to go over how you can do buy, fix, and hold properties when you're using a short-term loan, and then a little bit about how your long-term loan will look when you refinance out after the repairs are done. So this video is going to go over the math so you can know how your loans can be calculated, so you can see how you can do this between fixing properties up and then holding them long-term for short-term or long-term rentals. So let's begin. Here's an example of a real loan that we closed in Texas. We have purchase price at $100,000. The repairs are at $25,000. The after repair value was at $177,000. The yearly taxes were $1,080, and their insurance was $1,248 a year. So I'm going to show you how to close the short-term loan when you're fixing it and what type of out-of-pocket expenses you can expect on a deal like this. So remember from our other videos, purchase price is the one variable that you can control in investment real estate. You can't control how much it's going to be worth to fix it up because that's going to be dictated by the material costs and your labor. You can't change what it's going to be worth after you fix it up because that's going to be dictated by the market in which what finishes you've put in the property. So the one thing that you can control is purchase price. So on this deal, we lent up to 70% of the after repaired value. That's 70% of 177 would be $123,900. I'd hold $25,000 in escrow for your repairs. Just like on your fix and flip loans, I'm going to pull $25,000 out of my bank line and I'm going to hold it into a separate account for you. So when you ask for draws, the money is waiting to deploy back to your account once you finish a portion of your repairs. We put this deal at 3 points and then 10.9% interest-only payments. On your short-term loan, you're going to pay your origination points on your total loan of your funds that we're going to be closing with, which would be your $98,900 and your $25,000 repairs because we're actually pulling that from our accounts. Remember to ask your lenders if you're only paying on your drawn amount, are they holding your repairs in escrow or are they looking for funds to reimburse you with as your project goes, and see what kind of risk you want to take if your lender is holding your repairs in escrow or not holding your repairs in escrow. Document fee is what we pay our attorneys to draw your closing docs. There are never any upfront fees with a direct lender. Okay, so these are fees that you would see at closing if you decided to close. I'll also estimate for your title fee, since we will only know what title company is going to charge you until we get the HUD. Usually that's about a 1.5% of your loan, but always make sure you talk to your escrow agent to see if you can get actual numbers so we can adjust these numbers appropriately for you so you can see if you're coming out of pocket or not on your deal. Processing fees that pays for your flood certs and any kind of other reports that we would have to pull for closing your loan. So you can see your total closing cost is $8,178.50. But your estimated funds at closing would be $9,270.50. The reason for that is I'm going to close with $98,900, but you bought it for $100,000. So you have to come out of pocket your closing cost plus the difference in which I can't fund. Now, a lot of you are saying, but Alex, you said I could do 100% financing. Well, you can. If you buy it underneath what I'm funding at closing, so let's say you bought this for $93,000. You scroll down now, you can see you're only coming out of pocket $2,278. If you bought it for $90,000, you can see that it's green now. So if you buy it right, I can roll in all your closing costs, and that's how 100% financing works. You're buying it for less than what I'm funding at closing to cover in your costs. So let's work this back on the regular deal where this landlord bought this property to buy, fix, and hold, and they bought it at $100,000. So on this deal, you're coming out of pocket $9,278.50. Your interest payments are $1,215.43. That includes your monthly taxes. We escrow for your monthly taxes because let's say you close a deal in October. Well, you'd get January to September from your seller most likely. And then you would cover the rest of the taxes for the rest of the year. So when January comes and it's time to pay taxes, your money is waiting in escrow to pay your property taxes. Ask your lenders, if you're not using Jet Lending, if they ask for your property taxes. It's a good idea to make sure you do so, because nothing's more frustrating than when tax season comes and you got stretched on a deal and now you're trying to pay your property taxes and you don't have the money. So now let's say everything's done, the property is renovated, and you're now ready to put a renter in there or start doing some short-term rentals for your business. As we look at this, we can see that this is a 30-year loan now. So what is that? They're called DSCR loan, or debt service coverage ratio loans. What that means is the property stands alone. You can do as many of these as you want because it doesn't reflect off your income. It reflects how the property performs. So how it works is, if your principal, interest, taxes, insurance, and any association dues, and watch association dues, especially in condos, because that can really change your numbers. But if that's your PITIA, which is your monthly payment. If your monthly payment's $1,000 and you needed a 1.2% DSCR ratio, that means the property needs to be or can be rented for $1,200. $1,200 divided by 1,000 would be 1.2, a 1.2% ratio. So let me show you what this property looked like. Well, the first day on your refinance, you got to refinance and pay off all your lien to Jet Lending. So that was $123,900. I put a 25% vacancy in maintenance. That's usually average, anywhere from 20 to 28% seen in the industry for landlords. I'm just doing this for your profit estimates as well. So I'm going to not only show you what your loan's going to look like, but what does this investment look like when you're working with Jet Lending to say, are you prepared for this type of return? Does this meet your business plan expectations? So I put 25% vacancy in maintenance. You're out of pocket your first closing $9,278.50. The projected rent for this was $1,665 a month. We refinanced it at 75%. You can do purchases at 80%, but purchases do not allow repairs. So this is a refinance. So you're up to 75% loan to value on your refinance. This person got a 7.55% interest payment for 30 years fixed. Their projected closing cost for this deal was $3,717. And look at that. Projected out of pocket on this deal was negative $5,133. That means on this deal, when they refinanced, they were zero out of pocket. So they didn't have to come to closing because of the spread in how they bought the property initially affected their second closing. So they didn't have to come out of pocket the second time closing on the refinance because of the value of the property. So here's what's interesting. This is a 1.4% DSCR. It's pretty good. Anything above 1.2 is pretty robust. And you usually see these types of numbers when you're doing multifamily properties. They're making about $538.24 a month in cash flow, but cash flow is just the icing on the cake. All right, I'm going to show you why you use Jet Lending to buy these properties. So if you look at this at a 9% appreciation rate, which in Texas for the last 3 years has been double digits. So I just use 9% as a low end number. Your equity growth over 30 years was $477,900. Your cash flow over 30 years is $1,093,767.65. And then your estimated profit over 30 years was $800,000, a little over. And that's why people hold real estate. It's not the cash flow, it's the appreciation. The DSCR loans with Jet Lending are a way for you to get your independent wealth by gaining inventory that should appreciate over X amount of years of you holding the property. So the values are going to go up. The principal payment's going to go down because you're paying it off, and that spread is your wealth. It's wealth on paper until you realize it and you sell the property or you refinance it to buy other things. But I'm trying to show you a way in how you can grow your independent wealth using the buy, fix, and hold Jet Lending buy, fix, and hold to refinance products. If this doesn't meet your expectations on what you're trying to do on your business plan, give us a call so we can tailor something for you. But I hope this helped to go over some of the math on why people do this and how it works, and a better idea on how you should buy your properties and get your deals done here at Jet Lending.